Hi, my name is Jerry Yu, the Family Money Doctor. I'm glad you have found my YouTube channel. Please make sure to subscribe so you will not miss any future videos. Today we're going to talk about how to navigate the most important variant in retirement. See, retirement can be a scary thing. It represents the last 1/3 of your life that you have worked so hard to get to. Not only that, but navigating retirement can be extremely difficult because no two people's retirement will be the same. What do I mean? Because no two people have saved the same amount of money, have the same families, and most of the people may have different philosophies on leaving money to their kids and grandkids. All those different variants make each person's retirement unique. But when we talk about what is the most important variant in retirement, one thing you wanted to make sure you understand so you can navigate is taxes. Taxes can be extremely crucial when it comes to retirement. Think about it. This country was founded on not wanting to pay taxes to the British government. Now, as you have entered retirement, you probably don't want to pay taxes to the US government if you don't have to. That is what we're going to talk about today. We're going to look at 3 different buckets: the taxable bucket, the tax-deferred bucket, and the tax-free bucket. I want you to consider 2 principles when we're looking at each one of these buckets. The first principle is, if there is a taxes that you don't have to pay, let's not pay it. Second, if you do have to pay a tax, if there's no way around paying that taxes, let's pay as little as possible. Very simple. I want you to consider these 2 principles as we go through this. We're going to start with the taxable bucket. In this taxable bucket, you have things like a mutual fund, stock, money market accounts, and CDs. How do you know if an investment belongs in this taxable bucket? If at the end of the year comes tax time, you get a 1099, it means that you have to pay taxes on the interest earned every single year. That is why this is considered a taxable account. That's one of the cons, right? One of the pros is that money in this account are liquid, meaning you can access it quickly and easily, and you can use it as an emergency fund. How much money should you have in these taxable accounts or emergency fund? Well, a lot of the national pundits may not agree on much, but one thing they actually agreed on is that you should have at least 6 months of savings set aside as an emergency fund in this taxable bucket. Is it possible to have not enough money in that taxable account? Well, sure. If you don't have enough money in this account and an emergency comes up, that's how you get into credit card debt or taking on debts to pay for that emergency. Can you have too much money in the taxable account? Well, you can never have too much money. But however, if you have more than enough emergency fund in this taxable bucket, if you go back to the first principle we have talked about, if you don't have to pay taxes, let's not pay it. But if you do have to pay it, pay as little as possible. So the extra money in the taxable bucket, you are paying taxes every single year when you earn interest, dividends, or positive gain. How can we put that money in something where you are not going to have to pay any taxes? And let's take a look at tax-deferred bucket. In this tax-deferred buckets are 401ks, IRAs, 403bs, and 457 plans. These are taxes that you are going to have to pay in some capacity. These are probably the most popular accounts. Most Americans have their money in 401k or IRA. So these are the most commonly known or commonly used accounts. At the end of the day, if you have money in this account, you are going to have to pay taxes on them in some capacity, either now or in the future. And if you don't pay these taxes during your lifetime, then your beneficiaries, when they receive that money after you passed away, are going to have to pay taxes on them. We know what type of accounts go in this tax-deferred bucket. Now, when we decide to take that money out, it's taxed as ordinary income. That means at the time you pull the funds from your 401k or IRA, it goes on top of anything else you're making, and you pay taxes based on those numbers. Think about it. That's kind of powerful. That is a huge variable in retirement income. One, you don't know what your tax situation is going to be 10 or 20 years from now. And 2, you don't know what the government's tax situation is going to be. What does that mean, you don't know what your tax situation is going to be? Right now, most likely your 2 biggest deductions for most Americans are their house and their children and the dependents, their kids. When you retire, you'll most likely want to kick your kids out of the house and have your house paid off. And you lose those two deductions right off the bat. You are most likely in a worse tax position when you are retired than you are right now. And you probably don't want to lower your lifestyle in your retirement, and you want to do more things than you ever have before. So you have goals and things you wanted to accomplish, like spending time with your grandkids. But the other thing is, you don't know what the government plans to do with tax bracket or who is in the White House. These are things we don't know or beyond our control. A lot of people think of stock market losses, but not a lot of people think about tax losses. No matter what, we're going to have to pay taxes on this money. Even if you say, hey, I never wanted to touch it, the government is going to force you to take required minimum distribution, RMDs. See, when you start taking RMDs, you will pay taxes on whatever tax rate at that time. Based on how much money you have in the tax-deferred bucket and the taxable bucket, you should start talking to your financial advisor on setting up plans to move some money from the tax-deferred bucket to a tax-free bucket. The tax-free bucket, this is the bucket that everyone wants and should already have. See, the money in this bucket will be considered tax-free. That means you want to be federal, state, capital gain tax-free. And you want to make sure money in this bucket does not affect taxes on your Social Security. So when Social Security came into place, we were told that you will never be taxed on Social Security. But right now, you can be taxed up to 85%. That law has changed twice since its inception. And the reason this changes is because the government wants more tax revenue for someone who does not plan ahead. What accounts that fit into the tax-free bucket? One of the big ones is Roth IRA or Roth 401ks. The benefit of Roth IRA and Roth 401k is that you already pay taxes on it. So it grows tax deferred, and when you start pulling the money to supplement retirement, it's tax free. And you don't have the requirement minimum distribution to worry about. The downside of Roth IRA and Roth 401k is that there are limits on how much money you can put into these accounts. And if you make too much money, you can't even contribute to a Roth IRA. One other vehicle that's gaining popularity is cash value life insurance. Properly designed cash value life insurance fits in the tax code where you can put in as much money as you want into it based on IRS guidelines. Cash value in life insurance grows tax deferred as well as put it out tax free. In this tax-free bucket, how much money do you want in there? There's a thing called AMAT, as much money as possible. If we put as much money as possible into this tax-free bucket, that means when you put it out in retirement, you are not paying any federal, state, or capital gain taxes on it. And you are not adding taxes on your Social Security. See, if you do that and you can navigate everything and have as much money as possible in this tax-free bucket, then you are able to navigate these retirement waters the best you can. So just to recap, your taxable bucket is where you want emergency funds for 6 months. Anything else, and you are paying taxes on it, something that you don't want to do. In the tax-deferred bucket, you have your 401ks and IRAs. You are postponing your tax liability. You're going to have to pay taxes on them in some capacity. Then we go into this tax-free bucket. We want to fill this bucket up with as much money as possible. I urge you to talk to your financial advisor or life insurance agent to learn how you can navigate the most important variable, which is taxes in retirement. Thank you for joining us today. My name is Jerry Yu, the Family Money Doctor, and I will see you next time.